Hi guys, it's Whitney. How are you guys this afternoon? You guys want to jump all on over to your chat box and type in there and let me know if you can hear me and see my screen. That'd be great. All right. I got straight up 3 o'clock my time, 2 o'clock Pacific. So we'll go ahead and get started. If somebody would jump over to the chat box and just confirm that you can hear me and see me, that'd be fantastic before I get too far down the road here. Awesome, perfect. Thank you guys for doing that. All right, so we are going to dive into some content today, and then we'll move into some question and answer towards the end of my presentation. Couple things here. If you haven't already found your chat box, make sure to do so, because I want you, if a question comes up, I want you going to your chat box. I want you typing in the question. Don't hang on to it. Let's make sure we get all those questions lined up, because that's what we're really here for, is to make sure that as I'm going through the different, 3 secrets I'm going to cover today and the 4 tenets of conservative investing, I want to make sure that you guys are getting your questions answered. Also, towards the end, I'm going to ask you if you have additional things you would like me to cover, because this is going to be an ongoing webinar series, and I want to make sure that I am providing the best value to you. So just want to kind of put those things in your head right now. I am not going to go into full Google Slides clean screen share. I had some technical difficulties last week, so if you can bear with me with the view that we have here, we're going to work with it. All right. So what we're here to do today is to just cover how to get started as a passive investor, especially if you don't have any experience in real estate. So really, I just want to ask you, are you ready to learn the biggest myth about investing in syndications? We're also going to cover the 3 secrets to success when investing passively, and then also go through the 4 tenets of conservative investing, especially right now, so you can protect your money. So, as we start walking this road of passive investing, I've talked to hundreds of investors, and really, these are the 3 scenarios that I tend to run into with people. Either they've tried to get into syndication investing, but they've just gotten cold feet for whatever reason, or they've invested in syndications before, but realized that they maybe have made a mistake in the underwriting process, or they start exploring syndications, but then just get so overwhelmed by all the information out there. And I'm sure, I know when I was first starting out investing passively in syndication, at some point in time, I hit all 3 of these kind of roadblocks. But really, distilling all these things down, there's only one thing, there's one big myth that keeps people from investing in syndication investments. And that is, they feel like they have no control over the investment. And it's really this mindset that keeps many investors sidelined from investing in real estate, period. But really, I'm going to go over 3 key strategies, 3 key secrets that you can do right now in any real estate investment when you're evaluating any syndication investment. That way you can actually have a huge amount of control over the investment itself. Before we dive into those different secrets, I want to just kind of, for those of you who don't know me, my name is Whitney Hutton. I am the Director of Investor Relations here at Goodegg Investments. This is me and my goofy family. We're standing on top of the Coba Pyramid in the Yucatan Peninsula. This was actually last January. Our last big trip. Hopefully we'll have many more in our future. But this is kind of an epitome of why I got into passive investing and specifically multifamily investing. So you see, I started off in 2002 working, building capital through live-in flipping. It was a total accident. I purchased a house with a significant other, not my husband. And, you know, about a month or two after it closed, our relationship fell apart. And here I had a house. And, you know, I carried the whole mortgage myself. And I was like, what on earth am I going to do with this thing? So I was young. I packed it full of roommates. And I was like, okay, that's awesome. Now I got somebody else paying my rent, but I still need to rehab the property. So then I figured out how to take my rental income and feed it into the rehab of the property. And, you know, fortunately, my roommates were totally fine living in a construction zone for a while. And so that was my foray into my first live-in flip. 11 months later, I had a completely rehabbed property. And it dawned on me at that point in time that in 11 months, I'm sitting there about to sell the house, that I hadn't paid for any of my own housing in 11 months. And I was walking away with 52 grand in my pocket. Believe it or not, I was 103% financed on this deal too. I had borrowed $7,000 from a family member and paid them back immediately after closing. So those were the wild west of lending. I mean, we can't get that type of lending anymore, but it really just dawned on me just the power of real estate. And I was wondering how many more times I could do this. So fast forward a few years, I did a couple more projects myself. Then I met my husband and we did a couple projects together. And, you know, it was right around 2008 when we just kind of put the brakes on and started our family. I finished up school. And then in 2016, we decided that, you know, we needed to get back into real estate. We needed to figure out how to leverage more of this, you know, huge power of using other people's money and time, knowledge, and expertise in order to build our capital wealth and also cash flow for ourselves. So we hopped back in, and this time we bought a single family investment, a rental here in Colorado. And we scaled our portfolio to 30 properties. And then I just realized I had another job. I didn't, you know, here I am. What was different between that point in time in 2017, early 17, and what I was doing in 2002 is that I had a family, I had a career. I'm like, how on earth am I going to scale this thing? And then that's when I had already been investing in syndications. And I really just kind of like looked over to see how my syndications were performing as I was trying to walk this path of getting into multifamily investing on my own. And that's when I realized that I couldn't really beat those syndication investments that were sitting in my IRA. We all know, fast forward a couple years later, you know, here I am with Goodegg Investments. We've done over 24 deals to date. We have over 6,000 multifamily units under management and a $700 million portfolio value. But what's really cool is that we have just a tight-knit community of investors, and over 40% of our investors are repeat investors. So that's amazing. And these are just a few of the cool things that we've been able to achieve. Like in the past year, we've put out a book, we've put out a podcast, we've attended several different real estate conferences and visited many of our properties that are under management. So we're constantly growing. These are just a few of the people that we work with on a daily basis. But enough about Goodegg Investments. I want to turn this back to you as the investor. Because when you're thinking about how you're going to get into syndication investing, again, that biggest myth that a lot of us have, I know I had it whenever I was getting into syndication investing as a limited partner, was I feel like I'm giving up a level of control, right? I felt like I can control my single family rentals. I could control my flips. But when I go in and start evaluating a syndication deal, I was like, man, I feel like I'm giving up a lot of control. And that's not entirely true. So let's go through the 3 secrets on how you can control your passive investment. All right. Secret number 1, you get to choose the operator that you work with, okay? So let's go over how you can choose an operator to invest with actually, even if you've never invested in real estate syndications before. All right, so these are just a few of the questions. This isn't an exhaustive list, okay? So as we go through these webinar masterclass series, I'm gonna dive deeper and deeper and deeper into the various topics. But when we're evaluating an operator, I approach this, picking an operator is, who do I want to be the COO of my business. If my business is taking my hard-earned money from my active income, my active day job, or maybe other active investments I have, I'm selecting a syndicator or an operator to work with that I would want to be the COO over my money, okay? Which means I have to be very, very careful on how I invest with them. I want to know, what is their investment philosophy? Are they in it for capital preservation, cash flow, appreciation, development? Like, how are they orienting to investing? If I give them my money, what are they going to do with it? How are they going to protect it? Okay, what is their investment philosophy? What do they invest in? Do they invest in multifamily? Do they invest in self-storage, mobile home park, residential assisted living? Do they invest in note funds? Do they invest in parking lots? It's true, you can invest in parking lots, okay? Are they competent? So how am I going to measure competence with them? Anytime I'm hiring like an operator within a company, I want to understand their track record, and I want to understand their track record on the current deals they had just closing on, but also on all their previous deals that they've done to date. What are the performance of these deals? Okay, this is a huge question to be asking. I mean, at any point in time in the market cycle, but especially right now in the middle of this COVID-19 pandemic, what is the performance on their assets? Okay, and we want to understand how they're orienting to the performance of their assets as well. Okay, are they kind of glossing over the bumps in the road? Or are they actually taking the bumps in the road and reframing those hard learned lessons to actually improve their business? Do they have an exit? Okay, have they ever taken a deal, a big multifamily building, gone through the whole business plan? Have they refinanced it to return capital back to the investors? And have they exited a deal before and sold it? Okay, I want to understand that they've gone full cycle on a deal before. And then most importantly, the returns. Now I put that last, okay? I know when we're evaluating different multifamily deals, I do this as well. I tend to kind of focus on the returns, like what money is going to go into my pocket. But that's just one piece of the puzzle. Okay, I want to make sure that I'm orienting to all these other things that come first that are going to allow for better returns in my pocket. All right, do they work with sophisticated or accredited investors? Okay, so when we look at the SEC regulations, Regulation D, we have 506C regulation, meaning that you can only work with accredited investors. Okay, if I put out a deal that's 506C, I can only work with accredited investors, but it does mean I can advertise the deal. Many of our deals, especially here at Goodegg, we operate under the 506B part of the Regulation D, meaning we can work with accredited or sophisticated investors, but we can only have up to 35 sophisticated investors in a deal. Okay, so those tend to be very valuable slots. So I know when I'm talking to investors throughout the day, if I identify somebody as a sophisticated investor, I ask them to pay attention to their inbox. When a deal hits, I want them evaluating it very quickly, because I know that that deal only has 35 slots across the entire deal. And I want to make sure that, if I were a sophisticated investor, I'm acting quickly to move on a deal if I want to be in it. Okay. Another point, looking at point number 4, if you're sophisticated and you're looking to evaluate operators, you don't really want to be, kind of hitching your wagon to a group that only works with accredited investors. So that's a good question to ask them, what type of investors they work with. As point number 5, when you're hiring anybody in your business, anyone at all, you're going to ask for references. Same here, get references or ask other investors of what their experience is with that particular operator. Okay, you're going to get a great orientation and point of view on how that operator operates. All right, and then number 6, when you ask your questions, especially the tough ones, listen to how that operator responds. Okay, and listen to your gut. Right, our gut is kind of our first brain. My background is in is in public health and natural health. Like our gut's our first brain. It's there for a reason. If you're getting kind of the heebie-jeebies whenever you talk to an operator, be sure to note that and consider that as kind of good intel. All right. Secret number 2, choosing the market. Okay. So if we're talking about how we can have control today in our passive investment, number 1, choosing the operator. Number 2, choosing the market. How can you choose a market to invest in without being a data genius? So if you have pen and paper, let's break that out. I know I'm going to give you guys the recording, but I want you guys to write some things down today as well. All right. So when you're looking to choose a market to invest in, we want to look at several different things, okay? Points 1 through 5, okay? Those are the things we're going to look at the metropolitan or the metropolitan service area level. Points 6 through 10, we can look at those at the metropolitan level, but we also want to look at those things at the sub-market level where the actual asset is, okay? So point number 1, again, what we're trying to do here is stack as many investing cards in your favor as possible to give you control. All right, so point number 1, we want to make sure that we're investing where the population's growing, where incomes are growing, median home values are growing. Okay, so we want to make sure those things are kind of going up right now. We also want to invest in metropolitan areas where the crime trend is coming down. All right. Okay, that can be same for the metropolitan area as well as the submarket. We also want to look at jobs. We want to make sure jobs are growing and that there's a good industry mixture, right? I know Detroit gets beaten up a lot in the news, but when we looked at, when the car auto plant started shutting down in Detroit, that was a huge, massive job sector for Detroit. And we all know the story of what happens when that job sector left. Okay, the MSA was kind of in shambles for a while. So we want to avoid investing in metropolitan service areas that have a heavy industry sector like that. Right now we're in the middle of the COVID-19 pandemic. If I would probably steer clear of anything that had a high hospitality or cruise or gambling industry. Right now, or all 3 of those. I would really kind of, watch those industries over the next couple of years, but maybe stay away from those right now. All right, well, let's move to the right side. On the submarket level, and of course at the MSA as well, but especially at the submarket level, we want to invest in areas where the incomes are going up, where the rents are affordable, where the unemployment rate is close to the city unemployment rate or below. Okay, even if it's just like 1 or 2 points above, that's not horrible, but even if it's at the city rate or below, that's pretty awesome. We want to make sure that the poverty level is low. I like to be ideally under 15% poverty. If I can get lower, I will. All right, and then we also want to look at landlord-friendly areas. Okay, again, this is not a mutually exclusive list. It's not like you have to hit every single one of these checkboxes. There's no such thing as a perfect market, but if we can check as many of these boxes as possible when you're choosing a market, all the more the better. All right. So, and I've noticed a couple of questions that have come in. I'm going to table some of these questions here. And then I'm gonna, I'll wrap up before I go into our 4 tenets. So thank you for that. All right, so what we wanna do, by me going through that slide, I wanna make sure that you understand that even if you've never underwritten a market before, that you can actually become very proficient underwriting a market. And pretty simple, let me flip back to this slide here. You can grab your population data from Google, okay? So you can just type in, Tampa, Florida population, and you can actually grab the population of that metro area. You can grab also all these other data points other than the jobs trends off of a website called citydata.com, okay? It's pretty easy to grab those data points. You want to make sure that you're looking at the trends over time, okay? Not just the 1 point for the data collection in either 2017 or 18. Okay, data comes out in arrears, but you want to make sure that the trend is happening over time. And then for the job data, okay, the job growth data, you can actually go to a website called the Department of Numbers and grab your data there. All right. So let me just kind of pause here. It says, on choosing the right market is interesting, but I'm wondering if you could give us some examples of cities that Goodegg has identified that meet these criteria. Fantastic. So we at Goodegg, we actually invest in growth markets. So we're looking to these are the criteria points that we actually use when we're vetting our markets. So Forbes actually put out an awesome article at the end of November last year, where we were looking, or where they were looking in their research, or where the Fortune 500 and Fortune 1000 companies were moving their headquarters. Okay, what they came out with in those markets that corporations were prepping for the next downturn by moving their headquarters to Texas, Florida, and the Carolinas. And to even get more specific, where in those areas that were the hottest were the Dallas-Fort Worth metro area, Tampa, Orlando, and Jacksonville in Florida, and then pretty much most of the major metros in North and South Carolina. Our portfolio is heavily concentrated in the Dallas-Fort Worth area, Tampa, Orlando, Jacksonville, Greenville, South Carolina, and Raleigh, North Carolina. And then we will be closing on a deal here soon, another deal in North Carolina. When that deal closes, I can tell you where it is. All right, so those are the metros that we like. But again, it was kind of cool to see this research come out, and it like perfectly overlaid on top of our portfolio. So we feel like we're kind of gave ourselves a pat on the back. We feel like we're doing something really right there. All right, so first secret, choose the operator. Second secret, choose the market. Third secret, choose the deal. Okay, and this is, we're able to do all this research, ask all these questions, take control on these decisions prior to actually investing in deals. So we're gonna spend more time outside of just this workshop on choosing the deal, okay? But I wanna go over some high points right now. And then again, this is like, even if you have no background in evaluating a syndication deal, we're going to get pretty deep in future workshops and helping you walk through deal analysis on syndications. But from a high level, what we are looking at is what is the asset class of the deal. I'm going to kind of orient to multifamily because that's what we primarily invest in here at Goodegg. But you could take some of these data points and overlay them on other syndications. But we focus on value add B-class assets. And the reason why we love B-class is if you look at the data from 2008, when we saw Class A, those luxury apartments, people in those type of assets had to downsize to the more workforce B-class housing, right? So we got compression from the top down to B. We also got, that's in a down market. In an up market, we see compression from C up to B because people in the C class, they want to be next to better jobs in better school districts and have access to great amenities. So we see compression from the bottom up. The cool thing about the B class asset, especially our B class asset that we look to invest in, we look to take this workforce housing that's no longer being built. It's just too expensive to build anymore. And so we buy these apartment buildings and then we rehab them to give them an A-class feel. So that allows us to do several different things. I'm going to talk about that here in my 4 tenets of conservative investing, but that's where our sweet spot is. We also like to look for units, a unit mixture of 175 or more. I really suggest people to stay above 100 units or more, 150 or higher if you can. And the reason is that gives you an economy of scale behind your investment, okay? You know, you can kind of spread out your vacancy, your operational costs. You can also spread out, like you can have team members on site. You can have a full-time property management. You can have full-time handyman on site. So that just gives you a lot more oversight and management of the property. Equity multiple, okay. Equity multiple, this is for many of you probably a new term, but an equity multiple, it really means over the pro forma, the length of the pro forma, so our deals are generally 5-year deals. Over that 5-year period, if you invested $100,000 with us, what would we return back to you? Our deals generally yield a 2x multiple. That's what we're targeting. So if you invested $100,000, we're looking to return $200,000 back to you. Okay. Now that's through cash flow and the back end appreciation on the deal. Okay. So it's combined, but that you'll see that equity multiple on the investment summary, is either like a 1.9x or a 2x. So that's just kind of a quick way to compare different deals. Then you also get the internal rate of return number. Okay, the internal rate of return is the annual percentage that we were returning back between cash flow and the back end equity after sale. And we target between 16 and 22% on our deals. Okay, we're targeting about 8% cash on cash return. Okay, 7 and 9%, generally 7% is our preferred rate, but the cash on cash, if you look at the pro forma, is 7 to 9%. And then we look to yield another 8 to 10% on the back end. Okay, so we can make some great returns. Those are just our deals. You're gonna wanna kind of compare that across multiple deals. What type of lending is it? Is it from a private lender? Is it conventional? And I mean conventional, like Fannie Mae, Freddie Mac back type lending. Agency debt is what we call it. Right now, agency debt is kind of, what's operating for us right now. And not a lot of people can actually qualify that based on reserves. So this is something that I would continue to take a look at. But we want to look at this in tandem with a few other metrics. Okay, what type of lending is it? Okay, is it agency debt? Is it private debt? But we also want to look at the term of the debt. How long does the debt actually run? If our pro forma is saying 5 to 7 year hold, we want that debt to go out to 7 to 10 years. Okay. Whoop, whoop. All right. If you guys can stay muted, that'd be awesome. We'll open it up for question and answers here in a second. Okay. So we just want to make sure the debt length is at least for our term length, if not longer, okay, or hold length or longer. Also, what is the interest rate and is it fixed? Okay, then obviously, I think a lot of us, understand that the lower the interest rate, the lowers our expenses, but is it interest only and is it fixed and for how long? Okay, we want the IO period, the interest only period to be fixed for at least the term of our hold. Okay, and a little bit longer if we can get it. All right, and sometimes when you look at a deal, maybe it's only guaranteed, or we've only bought the interest only for like 4 or 5 years, and we want to know that we can exercise the option to purchase a longer interest only period. Okay, that's another way to kind of circumvent that timeline. So if it's not longer than your hold period, you want to make sure that you can actually buy another interest only period to keep your expenses down. All right, reversion cap rate. All right, when we look at our cap rate, we look at our exit cap rate on a deal, we want to make sure that exit cap rate, you buy the asset at a cap rate today, let's say it's like 4.5%. We underwrite our deals this way, but you want to look at deals where the operator is underwriting a reversion cap rate, essentially that the market will be worse at exit, not better. Okay, so take care, make sure to ask questions. If you see the entrance cap rate and the exit cap rate the exact same number, I mean, there may be some rose-colored glasses there, and you need to ask the operator, like, why is it they're underwriting at that rate? Also, you can ask for the sensitivity analysis, because that operator should have done a sensitivity analysis to see, what the reversion cap rate is. Okay, so that's another way you can kind of get at that number. Also, when you're underwriting the deal, we want to make sure that there are multiple comps higher than the subject property, and we're looking at this for the purchase as well as the rental comps. Okay, so we don't want to be the best property in town coming into the market. We don't want to buy high, we want to buy low. We want to make sure that we are below market on our purchase, and that we're below market on the rents, okay, and that we have some wiggle room to move there. All right. What is the projected rent growth? What is the projected rent growth? Okay, we want to make sure when we're looking at our pro forma, about 3%. That's pretty standard, for rent growth, and over time that's pretty achievable. Okay, right now in COVID, maybe not. We might not get 3% this year, but over the term, the hold period, we should average out to about 3% rent growth. What we don't want to see on a pro forma is aggressive rent growth, meaning that the numbers only work if you have to get to like 4, 5, or 6% rent growth in order for that project to work. Okay, so if we had to choose, I would go 3% or maybe even slightly lower at like 2%. Does the business plan work? And then what is the projected vacancy on a deal? 3% is pretty standard to underwrite on a pro forma, and it's pretty industry standard, right now. Now, again, we're in this, COVID-19 environment. We might see vacancy tick up a little bit before it comes back down. I mean, this is a very unique housing market. We're very different than 2008. There's actually an undersupply of housing, whereas in 2008, there was an oversupply of housing. So I don't see vacancy popping up on us too much, but maybe for the short-term period, economic vacancy props up. But when you're looking at the underwriting in the deal, we want to make sure that we don't have rose-colored glasses on, that we're actually underwriting vacancy into the deal, and that it's at least 3%, or maybe underwritten at 4 or 5%. Okay, underwritten a little bit higher. All right, I know a couple questions have come in. I'm going to table those till the end because they seem to be very market specific. All right, so we covered 3 secrets on how you can control the deal before you even get into it, okay? By choosing choosing the operator, choosing the market, and then choosing the deal. It's a little different than if you've done single family investing before, okay? Again, we're looking to invest in a business, not so much the deal itself. We want to make sure we invest in a good, solid business and a good, solid market. I like kind of orienting to this. Whole Foods will do all this market research, okay? They'll find like the best operators in the area, the best distributors, the market research before they even like break ground on building the store. That's what you want to do. All right, so the 4 tenets, how can you invest conservatively and mitigate and protect your money? Okay, mitigate your risk and protect your money. So let's go over those real quick. All right, number 1 tenet, capital preservation. Okay, so if we go back to choosing the operator, I said the number 1 thing you want to understand an operator's investment philosophy. For us here at Goodegg, our investment philosophy starts with capital preservation. You want to understand how the operator is operating by, are they actually executing Warren Buffett's number 1 rule of investing, which is don't lose money. Okay, that's how we operate here at Goodegg. Okay, and we can do this a variety of ways. When we're looking at investing in a deal, we want to actually make sure that we are raising our capital expenditure budget. Okay, everything to do the rehab at the very beginning of the project. Okay, we don't want to have to depend on rents or the business plan going perfectly for us to be able to use the income from the property to build the CapEx budget. Okay. That's a very valid way of building a business. You see syndicators do that all the time. That's just not how we believe in operating, because we want to understand that we can execute our business plan at any point in time and preserve capital. All right. So we raise the CapEx budget at the beginning of the project. Also, that's separate from what the lender requires us to have for our operational reserve bucket. So we actually have 2 buckets, large buckets of money when we close on our deal. Okay, so going into nobody could predict the COVID-19 pandemic, but I feel very comfortable on our deals because we're very well capitalized on all of our deals that are currently running, and then also moving forward into this environment. All right. Another way we can preserve capital is actually sneaks into our tenet number 2, which is we want to invest for cash flow. So If we actually are buying an asset that's stabilized right now, like say like an 89 to 91% occupancy, okay, maybe down like, you know, to 87%, and it already cash flows and we can return a distribution to our investor now, we're actually preserving our capital. Okay, we have cash flow is king, right? We've all heard that in real estate investing. It's that cash flow, it's because it's already stabilized that allows us to preserve our capital. All right, so again, what we're trying to do is stack as many investing cards in our favor at the very beginning part of our ownership of the asset. Okay, so tenet number 3, appreciation. Okay, so yeah, we do want to invest in assets for appreciation. Okay, that's where, you know, a lot of the bigger money is made. But how we do that here at Goodegg, and this is the model that I like, even my own active portfolio, is the value add. So we're buying assets low, okay, below market value, and then we are rehabbing the asset. Now you can rehab in a few different ways. We don't call it rehabbing so much in multifamily investing, we call it value add. We can add that value in 3 different ways. One, we can actually do a physical rehab on the property. Okay, we stick here at very cosmetic rehabs. We don't get into the electrical or moving walls or redoing foundations. We don't do the developmental type of rehab. We do specifically cosmetic rehabs where you can kind of get in, get out very quickly. Our rehabs are about just like, you know, a matter of days, 3 to 4 days. And so we can turn units pretty quickly. And when we do those rehabs, we can actually command more rent. We can get closer to market rent. So we actually capture that equity spread between like the current rent and the market rent. Number 2, we can actually decrease our expenses. Okay, so we increase income, we can decrease our expenses. We do that by reorganizing property management, maybe moving utilities back to the tenant. So we can do, you know, lower expenses in several different ways. And then number 3, this is something that you can't do very well in single family investing, if at all, and that's add additional streams of income. So we continue to add washer and dryers to our unit, covered parking, storage lockers, package lockers, all these different little valet trash, broadband internet. So all these little things that actually improve the value of our tenants' lives on the property. And we can actually put those dollars to the bottom line. When we do that, we push the value, because this is a business, it's evaluated as a commercial business. When we increase the net operating income, we're actually increasing the value of the asset. So this isn't like single family investing where or 1 to 4 multifamily investing. We can actually pull that lever and know how far we're moving the value of that asset. When you buy a home, your asset is only worth what the guy next door sold his for, like in the past 6 months. Not in this case, okay? We're actually able to kind of tweak that lever and pull that lever even harder. All right, number 4, tax benefits. Now I put this as number 4. I know a lot of people, they invest, they want this to be kind of their number 1 strategy when they get into syndication investing. They want to be able to accrue losses on their taxes to offset other income that they're bringing in. But I really put it as number 4 because I don't feel like the tax tail should wag the dog, so to speak. So how do we generate tax benefits with multifamily investing? We help protect your income on the property from Uncle Sam through simple depreciation. Okay, we can actually ramp that up and do what we call a cost segregation analysis, where we send an engineer in to the property and they're going to evaluate that property. They're going to, they've got their handy little spreadsheet. They're breaking apart the doorknobs, the hinges, the carpet, the paint, like the countertops, all these different things into their depreciation schedules according to the IRS. And then anything that can be depreciated in 20 years or less, we're pushing to the first 5 years of the project. And when we do that, we can create some huge paper losses for our investors. Now, this isn't just specific to us here at Goodegg, but this is a question that you want to make sure that you're asking is, is the operator doing a cost segregation? Okay. Again, this goes back to the scale piece that I mentioned as well, and the type of investment that the operator, or the deal that the operator is investing in. It's harder to do a cost segregation analysis on a smaller property, okay, because they are expensive. But on a larger property, you should do it. It's unwise if you didn't do it. But that's how we're able to keep your cash flow tax-free, as well as generate additional losses that you can use against other passive income. And depending on your tax situation, quite possibly other active income. Okay, so make sure you talk to your CPA about that. All right. So I have 340. We have, or 240 if you're on Pacific time, and we have cruised through quite a bit of information. I know we have questions, so I want to make sure we don't lose sight of those. But I just wanted, if you guys pop over into the chat box real fast, did you learn at least one new thing? And were you reminded of at least one new thing? Okay, so I want you guys to pop over there and let me know that. Also, if there's something that you wanted to learn more about, drop it in that box as well, because again, I want to make sure that we're tailoring these webinars to what it is that you want to personally learn about, so we can get you comfortable with this asset class. All right. And then if you haven't already done so, make sure that you join the Goodegg Investor Club. Our number one way that we actually communicate with our investors is through email. If you're not on our email list, make sure you jump over there to the Goodegg Investor Club. You can hit the Apply Now button. Also, if you know somebody that could benefit from these webinars, have them go over there and apply to the Goodegg Investor Club as well, okay? And the club is for everybody. I mean, if you're just starting out, or maybe you're investing pro, maybe you're doing this on the side or full time, if you haven't invested in a deal yet, or maybe if you've invested in several deals, there's really a wide range of people that can fit into this club. All right, so make sure that you pop over there and that you're taking care of that. All right, so questions. All right, I know I've got a couple questions here in the box. So while I'm tackling this, make sure you go over there and type in the box what your question is, and we'll get those answered for you today. All right. Would I mind sharing the link to that Forbes research I mentioned? Yeah, I can dig that up, and I will send it out to the email list. All right. You mentioned that Orlando is one of your target areas, but it's a highly touristic area with various theme parks. All right. Yep, it is. It is, it is, it is. Can you address the performance of your properties in these areas due to COVID? Okay, awesome. So currently, it's really early. We're really early in the pandemic. Right now, Orlando, yeah, it is heavily on hospitality. Surprisingly enough, I looked at the statistics for the area, and total hospitality industry was 14.9% at Orlando. And on our particular property that we have there in Orlando, we found that only 2.3%, I believe, it was either 2.3 or 3.2. So a very small amount actually fit into that particular job category. So we're actually don't foresee us being greatly affected by that, directly, with the tourism industry on that property, because I think not the people that are at the theme parks aren't the ones that are renting there on that property. But only really time will tell. Currently, that particular investment continues to distribute. So we'll keep anybody that's currently invested in that deal will get regular updates on that. Okay. Does Goodegg Investment personally invest as a general partner in the deals that shares with its community? Yes. So we are part of the general partnership. So we either invest as a general partner or as individual LP investors ourselves, or sometimes both. Okay, so that's a fair question to ask. It does, in theory, it creates an alignment, but so I'd always ask the question for sure. All right, what is the typical minimum investment amount? For our deals, we look for a minimum investment of $50,000. Okay. Sometimes we're able to negotiate a lower minimum, but that's not very often. So typical minimum investment is $50,000. All right. I'll hang out here and field a few more questions. But again, I just also want to kind of like put it back in front of you guys. What other topics do you want to see covered? I've seen a couple people drop some ideas in the chat box. I want to make sure that we're capturing those. So make sure to jump on over there and share that information with me. That would be fantastic. And if you want to hang out here as I continue to answer some of these questions, do so. That's totally fine. If you need a bolt, I understand that as well. Thanks for hanging out with me today on how to get started as a passive investor. And there's my contact information below if you need to drop. Thanks for joining. Otherwise, I'm going to hang out here for a few more minutes and answer some questions. All right. What is the advantage of going through Goodegg as opposed to directly through one of the general partners? So what we do here at Goodegg is we provide a level of underwriting of the actual, so we talked about the 3 ways you can actually control the deal: investing in the operator, investing in the market, and investing in the deal. We do all that underwriting before we even put the deal out to our investor base. So that is, there's a huge level of due diligence that goes into a deal before we even put it out. Just because we have operators that we work with, we don't actually put out all their deals. Okay, they have to hit our certain metrics before we put it out. It doesn't mean that it's a bad deal. It just means it just doesn't hit our particular metrics for our investment. So that's an advantage we provide there. If you're busy, being invested with multiple operators and learning all their different systems and communication and how they're tracking investments can be a little overwhelming. What we do is we provide one point of contact to handle all of the investor relations, the administration, and all those pieces for you. Also, we have oversight over the day-to-day operations of the property, so we're giving you an added layer of protection in your investment. It's at no cost to you, okay, to do that. So it's entirely up to you, but if you're looking to have help in the underwriting, if you're want to have like a streamlined form of contact, and you just want to have greater oversight on your investment, we would be a good partner for you to work with. All right, do you have an in-house property manager or a third party? Our property management is usually we partner. So if you look at the general partnership, the asset acquisitions, management, investor relations, and the lending piece, we actually roll up property management under asset management, okay? So we're working as part of the general partnership to identify who the property management should be, all right? Where do we find our syndication deals? Oh, you're asking for our direct business partners. Oh, you're so sweet. Actually, we focus to work with longtime operators that we have a long-standing business relationship with. Again, we're looking to underwrite the operator on all those metrics that I put up here, and then we have a more extensive list as well. So, and just because somebody that we don't partner with you syndicators. I mean, we want to make sure that we have, just as much as you want to know, like, and trust somebody, we want to know, love, and trust somebody. I mean, because we're hitching our business to them as well. We've known these people that, we partner with for, years before we actually bring their deals to our investors. All right. What if you're not an accredited investor? Yeah, we actually do work with sophisticated investors. Again, we operate majority of our investments under the 506B criteria, meaning they're open to accredited investors, and we can take 35 sophisticated investors into the deal, okay? So, that's really important. You still have to get yourself in a good, solid monetary position, financial position as a sophisticated investor, and then also get your level of knowledge up. When I'm talking to an investor and evaluating whether they're a good, sophisticated investor to work with, I want to make sure that I am comfortable that they can actually underwrite the deal, okay? Even though our team is underwritten, I want to make sure that, they have a good working knowledge of how the deal actually works and can make a good investment decision. Aside from updates from the sponsors on deals, what other information does Goodegg provide to the LPs who have invested through them? We actually we provide all of the monthly communication. We right now are providing COVID communication. We are on our deals. We underwrite all of the quarterly financials, and so we're writing financial reports for our investors. We're also giving you all of the trailing 12. Okay, now if the asset is run less than a year, it's closed within the calendar year, you'll get either a T3, T6, or a T9. But we do the trailing 12 for our investors, and also the rent rolls. So we provide that additional information. I would also look for some other cool developments from us going forward this year, just to connect our investors to a more kind of like Q&A type scenario, something like this, to where we can have a dialogue with you about how the deal's going. And then at the end of every day, you can always pick up the phone and call myself or call Julie, and we can walk you through exactly how your portfolio is performing. All right. Well, thank you guys for joining today. I'm gonna hang out here. I got a couple more questions that are coming in, and then we can wrap up from there. All right, so what other types of investments have you done besides multifamilies? As Goodegg, we've invested in mobile home parks and self-storage. Okay, but currently we're providing multifamily investments. I would look for a couple other, kind of cool offerings coming here in the next few months, but that's where kind of our bread and butter of our portfolio. Personally, I've invested in mobile home parks, self-storage, residential assisted living, and I have my own active flipping portfolio, and then BRRRR investing portfolio. So, and that kind of, Annie has a similar experience, and so does Julie. So we all have kind of a background, wealth of knowledge in various investments, real estate investments. I also do some lending, personal lending, and then note investing on the side. So that's another area of my portfolio. How are we different from platforms like CrowdStreet? Okay, so I'm going to actually kind of pull it back a little bit, because CrowdStreet operates under a different regulation. What we do actually is we actually underwrite the deal. A lot of times and I'm not going to speak to CrowdStreet directly. I only know of one, questionably two, crowdfunding platforms that actually underwrite the deal before they put it out to their investors. So they're actually part of the general partnership and co-sponsor to before they put it out to their investors. Majority of those platforms are actually marketing platforms, where a syndicator can actually just pay a fee to the marketing platform to put the deal on. There's really no underwriting going on. So if you're looking for an investment strategy that isn't peer-to-peer lending, to where you actually get direct access to the deal, you actually have like ownership into the LLC that holds the deal, and you have the hard asset, this would be something that would be, a syndication investing, with like a group like ours, is something that I would check into. Just be really careful about those CrowdStreet, or excuse me, I shouldn't say CrowdStreet, but crowdfunding platforms, that you really fully understand how they're operating, because they don't always, a lot of times they can actually operate like a marketing platform. Okay, so make sure you're taking some great care there. Again, going back to our 4 tenets, we want to make sure that we're protecting our money. I mean, we've worked hard. I mean, our money is, we've traded our time to get it, in a lot of cases. So we want to make sure that we're really protecting that investment. All right, guys. Yeah, you're very welcome. I'm happy to explain that to you. Yeah. So, well, thank you guys for joining me today. If you think of questions afterwards, feel free to just like shoot me an email. I'll pop my contact information back up there. And it was such a pleasure. And if you think of other ideas of topics you would like me to cover, make sure to shoot me an email as well. Otherwise, thanks for joining.